Hello, my dear family and friends. Thank you for joining me for this third video where we're going to talk about how to avoid emotional trading. If you remember, in the last video, we talked about 6 mistakes made by traders. Even people who've been trading a long time, they still make these mistakes, especially when it comes to emotional trading. So before we get started, let me briefly share with you why I started making these videos and putting them on YouTube. My daughter asked me about learning about how to invest in the financial markets. And so I thought, what's a good way to go about doing that? And I thought, well, I'll make some videos for her, have her watch them, and then I can discuss the questions with her and make sure she understands it. So after I made the first couple of videos, I realized, this could be good information to share with other people as well. So I started putting them on my Facebook page as well as on YouTube. Now going forward, I've decided that I'm just going to emphasize and putting them on the YouTube. And I'm new to this whole process of making videos, making presentations. I have made presentations in the past, but nothing fancy in the sense that I wanted to show to other people so much, but I have done presentations in the past. And so I decided to, making these videos and post them on YouTube. And I do believe what you're going to learn in these videos are very, very valuable. It's taken me literally years and a lot of time and money before I was able to understand how financial markets work and understand how these mistakes are made, and finally to be able to have a successful trading plan that would allow me, and I'm sure will allow you, to make successful trades. Now, when we're talking about trading plan, this is a nice quote from the book Market Wizards by Jack Schwager. He's a very famous trader. And he says that trying to win in the markets without a trading plan is like trying to build a house without blueprints. These are costly, but they can be avoided. A trading plan simply requires combining a personal trading strategy with a specific money management and trade entry and exit rules. So we're going to understand this today. That's our theme for today's video. Now, before we do that, again, please take a moment and read this notice. And remember that what we discuss here is for educational purposes only and not recommendations to buy or sell any particular financial instruments. Now, trading carries with it a lot of risk, and also you can make a lot of profits from it. And that's why emotions come in, and because of that, people make really bad mistakes. Now, the way we go about understanding markets, financial markets, is that by looking at the past history, we look at charts, and that's where you're going to learn to start looking at charts. But having said that, these charts may or may not be duplicated in the future. And that's why it's so important when you start trading, start with paper trading and understand your trading plan, understand your strategy, understand when you get in and exit the trade, and do it enough number of times that it really becomes like a second nature, almost mechanical, as if you set up this information on a computer and the computer is making the trades for you, which some people are actually doing that, and big banks are doing that, and so forth. So then, absolutely, before you start trading, please make sure you understand what you're doing. If you need to consult a registered financial advisor, and have this trading plan that includes risk, your risk, and how much you can afford to lose. And when you start, please paper trade. And when you go into with real money, please start with a very small amount of money. We're going to talk about risk today as well. And most traders lose money, so you want to start small, that if you lose that money, it does not affect you, your quality of lifestyle. So then, when it comes to risk, then, Mr. Warren Buffett says risk comes from not knowing what you are doing. And that's so true. And that's why money management becomes so important. Probably is the most important part of trading is money management. And his teaching on money management is very simple. Has two rules. Rule number one, protect your money. Rule number two, follow rule number one. Now, some people may think, well, I'm going to protect my money, put in the bank. But is that really protecting your money? We talked about it in the past videos that there's inflation about 3%. You pay taxes on that interest. And so you need to make at least enough interest to offset those. But then in order to have a gain, you have to make higher levels of income. And so with putting money in the bank or very, very low risk, so-called low risk type of places, you actually losing money. You're actually taking a risk with your money. So that's why I think it's so important to understand about financial markets and be able to manage your own finances. Or if someone else doing it for you, at least you know what's going on, so you make sure they're doing a good job for you. And of course, then, as this quote says, if you want to be more powerful in life, educate yourself. And that's so true for anything we do in life, whether we're talking about going to school, getting a job, or working at a job, starting a new business, starting a new family, anything you want to do in life. You need education for that. And that's what we're going to be discussing here today, education. So first thing, I think is important to understand about emotional trading is that it really comes because of our human nature. We are emotional beings. And as part of that emotion is, greed and fear. And we need to be aware of that we also have that nature within us as well. And when it comes to financial markets, actually it's probably true in business and a lot of places too, that, the greed takes over instead of people being there to do a good job and because of that get paid. A lot of times the greed takes in. And especially this is true about financial market because once you go inside of a trade, you'll see how your money going up and down. And before you know it, you start trading with emotions. So we need to understand our human nature a little bit better. And by the way, I started also making a series of videos about human nature and how we can live a fuller lives and better relationships. And if you're interested to listen to those videos, please let me know and I'll send you the link for them as well. They're also on YouTube. Now, the reason we want to go into trading is because we want to make money. Why? So we can improve the quality of our lives for ourselves, for our family. Maybe we can at some point be able to reach out to others, help others, either educate them or help them with finances if they need to. Maybe you want to give money to your favorite charity. That's very important that always we keep that in mind, that we do have a good nature. It's a wonderful nature that always wants to improve itself, becomes better, and also to do good for others as well. And what happens then, especially in trading, when you're in a trade and you see your money going higher, if we talk about trading last time, how different emotions kicks in, how different mistakes are made. One is that, remember we talk about market coming down here, people get burned out and the market start going back up. And then at some point they say, okay, I'm going to get back in the market and they start going higher. Now they see they're making a few dollars and suddenly they want more. Greed kicks in. And not only with just that one trade, you may be a successful trader making really good money every week, every month, every year, but then you want more. But, how much is enough is enough. And so you need to understand that the same thing with each trade as well as your weekly goals, your monthly goals, your yearly goals, income for trading or for other places of income. You want to have goals that they're achievable. At the same time, it's really for betterment of your life and helping others, and not is based on greed. Then marketers start going the other way. Here's where fear kicks in. Now I'm losing money. I lost the last few trades. I'm losing again. And so what happens then? Despair and frustrations, and because of that, emotional trading begins to happen. We're pounding the table. We're praying. We're desperate. We are hoping. We want a revenge. And so that's how people lose money in the financial markets. And so then what we want to do then is be able to avoid all this. We don't want to get in the market late. We don't want to sell late. We want to learn when to get in down here and to get out up here. We want to get in down here and get out up here. So then there are three steps to a successful trading plan. And your trading plan, to me, should be at least 70% successful, have been winning trades. And with this plan, if you practice our plan, you'll see you will get 70% plus winning trades. Now, you can be a successful trader if you do things right, even with 30% winning, 40%, 50%. Most successful traders, they're making around 50% or so. But we want to get to a point of making 70% winning trades. And then you want to do that with paper trading. And then when you go with the real money then, after you reach the 70%, then we want to start with a very small amount of money that you can actually lose. Why? Because 90% of new traders lose money when they go in the financial markets. And the reason for that is lack of education and emotional trading. So we're going to discuss the education, but the emotional trading is something you need to have the discipline of applying the things you learn into trades that you take. So the first thing we need to do is to qualify a trade. Now, we talked about we want to buy low, sell high. Remember, we talked about this. So we don't want to buy something expensive. We want something that's oversold, and we want to be a good financial instrument that we know is going to turn around with a good chance of going our way again. So that's the first thing. We're going to talk about it more. You see how you're going to qualify a trade that you're going to take. Then, remember, the way we trade it, let's want to buy something. This is let's say, a very good stock that has gone down in value recently. And so we want to wait. We first want to look at this and see it's oversold. This is low point here. We want to turn it around and go back up. Now, when do we get into this? We want to wait till it creates a nice trend, upward trend. We don't want to take a chance, buy it, and it goes against us again. But now, because we're using really great instruments for trading, you'll see that even if it goes against you here, we're not going to get scared. First of all, we're going to talk about our exit plan so we can get out with a small loss. But even if you happen to hold on to it longer, there's a great chance this is going to come back and go back up again. So we're going to use really great stocks or financial instruments that we're going to use. And then we want to have a strategy for when to get in the trade that is telling us the trend is changing, and we want to get in that trade. And so then we're going to talk about three different strategies. One is going to be aggressive. When you get in, is more aggressive. The other one is moderate. It's really good. The third one is our conservative one, and this is what we're going to discuss mostly. And even this conservative strategy for when to get into a trade, it gives us about 70% success rate. That's why I want to experience this 70% success rate. And you'll see it for yourself through paper trading. And so then Now we're ready to take the trade, but before we do that, we need to know our exits. Remember in the mistakes, one of the mistakes was having no exit plan. So we want to have exit plan. And part of that, as I mentioned a little bit earlier, is that what you trade is so important. So we qualify our trade first with the proper instrument. And then we need to have the right size of a trade. We don't want too big of a trade size that if it goes against you, you're going to lose money. And we're going to start with 1% of your account. So let's say you start with a $5,000 account. 1% of that is $50. This is the maximum loss or maximum size of the trade. Actually, I should say this is the maximum loss. Not the size of a trade, but the loss that we're willing to accept. That way, if we lose $50 and we have $1,000, $5,000 then, so it takes us at least 100 losses before we, lose our trading accounts, which is possible. Some people lose them very quickly. Now, what happens in trading is that, people don't have a stop loss, so they have big losses. And then they get scared. And so when they win something, they get out very quickly, small gains, and then big drops again. And this is one of the major problems for trading, this way of trading, having big losses, having small gains. So what we want to do, first of all, we're going to minimize our losses. We're going to start with 1%. Once you get better at 1%, we can go to 2% or a little bit higher, but 1 to 2% is sufficient. And then our exit plan is that first thing we look at is that what if it goes against us? How much loss am I willing to accept? And we're going to show you exactly where the stop loss is. This is where you exit the trade if it goes against you. And you may have heard they say, cut the losses short. And this is how we're going to cut the losses short. So, market come down here, it goes back up here. We want to get in at this point here. Where do we get out? We want to have a clear exit plan that will show you based on the charts, not because we think we should lose this much or we're going to hold on to it till we lose that much. No, we're going to know exactly based on the chart where is a good place with a high probability that it will not go against us. But if it does go against us, then we know when to exit that trade. So we keep our losses short. Another part of the exit plan is then we want big gains. These are what we call our targets. If you get in the trade here, then how much gain should you go for? And we don't want to get greedy. We don't want to have, unrealistic goals. But then based again on the chart analysis, we're going to have realistic goals. And this is how we let the winners run. You may have heard that, let the winners run. So if our first goal is here, we're not going to get out before we get there. We either go this way or we go this way. And so when we make money, this is at least maybe 2, 3, 4 times of this size of loss here. And so then even if you have like 30% or 40% gains, you're going to be a successful trader. But we do want to go for 70% plus gains. And so then what's important is then we want to have predefined stop loss and targets. So before we get into a trade, we know exactly what our loss is going to be. We know exactly what targets is going to be. And then we're going to set it and forget it. You've probably heard that commercial many years ago, set it and forget it. Now, of course, once you have this trade set up, you say, I want to get in here. This is your target. If it goes against you, this is your stop loss. This is where you're going to get out. And you can put alarms. We show you how to set up alarms. So when the market gets to either one of these points, you can get in and look at the charts. Now, you can have a stop loss already set, but I would encourage you not have a stop loss set in the computer. If you can, when the alarm comes, you can go and take a look at it, especially the way we trade. We'll discuss that more. That way you can come and take a look at the market and then see if that's a good place to get out. Or you can come and look at the market, see, okay, is this a strong trend? Is it going to break through this, go higher? Or is it going to turn around, go down? Or is it going to go sideways here? And so then you can make a decision, if you like, based on that. If not, then of course you can set it up in your computer and don't even worry about it. Just let it happen. So then, what's going to do this for you? If you have a trading plan, the way we discussed, it's going to keep the emotions out. Now, the reason emotions kicks in, let's go over that very briefly. We're going to discuss this more. Is that once you set up a trade, it's not going to go straight up. It's not going to go straight down. Yeah, sure, once in a while because of news or something, you may see the markets move really fast, and we're going to try and avoid those times. And but what happens is that you get into a trade at this point, start going your way here, and then it may come back down. You're into a loss. Now your stop loss is down here. Then here you may get panicky and get out. And then you see this goes back up your way. And so people a lot of times says, as soon as I get out, market goes the other way. Or market's going up here, and then we need to know market is going to wave and goes back down again. So you want to be able to get out when your target is reached. And so then, once we have understanding of the market, the way it behaves, the way it works, the way patterns are created, and then is your discipline of really setting and forgetting it and not to tinker with this trade. And a lot of times you'll see people, as soon as, they get into a market, they start looking at it, the market going up and down, their emotion kicks in, they start managing it, they buy more, they sell too fast. So we want to avoid all that. We just want to set it and forget it and let the market do what it will do. Now, we want to make this simple and doable. We don't want to be too difficult. And you can literally spend a few minutes a day. Of course, when you're first learning, I would encourage you maybe spend a little bit more time every day to study this, keep things fresh in your mind. But then once you get good at this, you'll see you can trade anywhere, anytime. Markets are open literally almost 24 hours a day. You can, based on what you want to trade, you can be able to trade them sometimes 24 hours a day. And this way, then also you leave the anxiety out. Your emotions don't kick in. When you go to bed at night, you know everything done, and you leave it alone. You're at peace. And when you start making successful trades this way, then it builds confidence. And that's so important in trading then. Once you build confidence, then you automatically set it up and forget it and have no anxiety, you feel comfortable. And then, whether you're managing your retirement plans or you're managing your other accounts that you want to manage and trade inside of them, you'll see then all it takes a little time to be on top of things, especially if we do this every day. And so that's what our plan is. So then I'm going to look at some charts for you. Make sure you, by now, you have set up your charts. And also, please, if you have any questions, feel free to email me at swingtrade2financialfreedom@gmail.com. And also, you're welcome to join me on Sunday nights from 8 to 9 p.m. with any questions you have. And this is a free webinar. I don't charge anything for that. This is my way of giving back to my family and friends, to our community, to the world around us. And so feel free, come online and study with me. And of course, I can have so many people at one time, so I would appreciate it. Then you email me, and then I'll give you the link. You can join me on Sunday nights with your questions. So then let's look at some charts and make sure you have set them up properly. Okay, so I've opened my Thinkorswim platform, and I made a video earlier that talks about downloading Thinkorswim. I'm not associated with them in any way, but it's a great trading platform. It allows you to paper trade any financial instrument that you like to practice with, whether it's Forex, futures, stocks, options, gold, silver, what have you. And it's free. And so you can paper trade with this. Now, you need to keep in mind, of course, then, they provide you with delayed timing. So it's great for paper trading, but when the time comes for actual live trading, of course, you want to have the actual minute by minute, exactly the feed that shows you what's happening to the financial markets. At that time, we can discuss more how to do that. You may want to, put some money in your account and work with Thinkorswim, or you may want to have another broker. If you have questions on that, please let me know. We can discuss about it. So here's a chart that we start with. Now, as you can see here, and we talked about it briefly before, there are red and green bars. These are called Japanese candles. In rice traders in Japan about 400 years ago, they came up with these bars and how they come together. You see different sizes and different patterns. And with that, they traded very successfully. They traded rice successfully. So that's what we're going to use. Now, if you have a different chart, a different style, you can come here and set it up. So you go to a style here, and then you see when you come up here, it says chart type. Here you have different types, like this is bar chart. This is the Western chart for setting up bars. And you may want to come and sometimes look at it as a line. So here's a line. It shows you this price changes with a line. Now we're going to set it up with the candle. It's called Japanese candle. We're going to set it up here. Now, we will have a whole discussion about Japanese candlesticks, but basically, if it's red in that time interval, right now we're looking at this is Visa, V for Visa, and it goes back 1 year, and we're looking at one day. That means each bar is 1 day, and so then if you see a red, that means for that day. It started on top and closed on the bottom. So if this is your candle, and you see sometimes they have wicks, sometimes they're big wicks, sometimes small wicks. So if this is red, and you can color them the way you like. Some people have it black or white. But let's say if it's red, I like to see green and red. That means for that day, market opened up here and closed at this level here. And throughout the day, it went up this high and came this low, but this is where it closed. And so if it's green, if this is green, let's make another one. If this is, let's color this. Let's say this is green. And then also has some wicks. And again, the wicks could be different sizes. So this was red, and this is our green. That means in that day or that time frame, could be a 10 minutes time frame, could be a week time frame, it opened up at this level here, it closed at this level. Throughout that time period, went up that high and came out this low. Okay? And the other thing is you're going to notice that some are very small and may have a little wick or a big wick, and some of them are could be really big. And look at here, this is much bigger than this here. Look at this, much bigger. Look at here, much bigger. So we're going to study this more. They tell us a lot about what's going on because this is, remember, a marketplace is nothing but buyers and sellers, right? So we have buyers and we have sellers. So and think of it as an auction. In an auction, could be a few people, could be a lot of people, but basically somebody or some people may think, hey, market is going to go higher, and they're willing to pay for it to go higher. Some people say, no, it's going to go lower, and they're willing to sell what they have, or in some cases, like, futures and forwards or options, you can actually sell something to go lower. With the stocks, you normally cannot sell it unless you own it, then you can exit it by selling it. So then if a person thinks, or people, a number of people, depends who's in that auction thing, that market is going to go higher, they keep buying. If not, it goes down. So when you see this green candle here, in that day, the buyers were in charge. They took over because they thought it's going to go higher, and they keep going up higher and higher. Sometimes it goes pretty fast, sometimes goes up and down, and it still goes higher. And if it's red, then for that day, the sellers were in charge. Now keep in mind, some buyers are big institutions. I refer to them as sharks. They're out there to take your money. We are the little fish out there. And some are, retailers. There are especially a lot of novices that are trading with emotions. They don't know what they're doing. They don't have the education. And so those are the people, unfortunately, start getting eaten alive financially by the big sharks. So what we want to be able to do is that understand the market and then be able to go in and get out property to manage our finances and be able to make a living out of that, or just make some additional income. So once we did that, the other thing we're going to look at, look at here. See, remember we talked about market comes down and then goes back up, and that's exactly what happened here. So then the way we decide on an instrument that we're going to trade or not, we're going to create a 20-year monthly. And so whatever financial instrument you want to trade, my suggestion is wait. First, look at the monthly chart and see how nice this looks. This is for Visa. And you see how it goes up, goes a little bit sideways, goes up, sideways, goes up, a little bit sideways, up. Here's a down here and back up again. So what's happening here? Well, when people start buying, market goes higher. Then it gets to a level, the price-wise, at that time, people think maybe it's getting too expensive. Or some people are taking profits, and you see market coming down or goes sideways, or some news comes in, something goes on, maybe it goes up a little bit more than normal. You can see here how the, what we call retracements are very shallow. It's not much retracement at all. And that's what you want. The reason if something goes down, is just the market going up and then start going back down. Now, a lot of time this is profit taking. Okay? And that's what you want. You want what we call shallow retracement. That means really, financial instruments like they're buying it for their mutual funds and retirement plans and what have you, they don't want to get out of this. They're holding on to this. Now, day by day, of course, you'll see, market goes up and down. But then if you understand, this is a strong stocks. I call them the strong stocks. Or strong financial instrument because they have a wonderful trend going up over 20-year time. So, let's say you want to check Apple. So we're going to put Apple here. And the symbol is AAPL. And then you can see, okay, what's going on here? Well, as you can see here, it started slow here, went up, came down. This is people taking profits. See here, nice and shallow retracement. This was a bigger retracement here. And this is another retracement. It's very similar to this, so you can see their patterns created. Then it goes up nicely. Then it was a big drop here. This is where the markets dropped, last few months. You remember that, and start going back up again here. Okay, so that's the first thing we want to look for. All right. Now, let's look at another company. Let's say, for example, Starbucks. All right, so here again, you look at it and you say, okay, let's study the 20-year chart. Well, it started here slow, went up. Here was a big drop back to where the price was. So, if you see this at this point, says, hey, I may not want to trade this because I don't really see a good path for this stock. But then you start going up, breaks this point. Now you can see very nice trend going higher. And again, now you can see the patterns came down. See this size, very much similar to that size. Went up here, it came down here, so it went sideways. And I'm going to discuss all this more, these patterns. And looks like right now it's taking off again, and is the highest point is been. And what's nice with Thinkorswim, market for this is the highest point. Another nice thing about Thinkorswim is that it marks when the let's put a daily here. It marks here when there's some events going on. For example, here's the earnings event. This blue lines here. Here's the this is the earnings discussions afterward. This is here dividend. So you can see exactly this information right on your charts. And of course, if it gets close to this earnings times, we don't want to trade the stock because anything could happen. When the earnings comes up, sometimes they come up with great earnings and people sell, sometimes come up with lousy earnings and people buy. So we want to avoid those times. We want to trade at times the market is quiet. We also want to learn about when the major news comes out, like unemployment we just had on Friday. Normally on first Friday of each month, you can see they talk about the unemployment and so forth. Sometimes a discussion about changing the interest rate. So these things can really move the market, and so we want to avoid all that. Okay, so then in the next videos, then we're going to discuss these charts more. We're going to find out how we can find the oversold areas and when the market is overbought, so we know how to trade accordingly. So thank you very much, and I hope to hear from you. Have a wonderful day. Take care.